In a complex environment of very low sovereign yields, high yield offers attractive returns without the volatility of equity. Alain Krief is head of fixed income at Oddo Meriten Asset Management. He joins us to discuss portfolios of B++ to B- bonds. Alain, good morning. Welcome to the studio.
Good morning.
First and foremost, of course, high yield. Why now?
Well, the current environment is still very complex. We know that we have good economic activity in Europe, but we have still concern over global growth. In Europe, we know that the recovery of economic activity is very good, and we can see that in the balance sheet of corporates. In particular, in the high yield, it is very good. Why? Because these companies have access to the refinancing market. They have access via the banks or via the bond market, and it's reduced the refinancing risk for this company, as we can see.
And their ratings have improved quite substantially.
Exactly. We can see that here on this graph that the good shape of European company is quite recent.
Yes, it is indeed.
And it was the case in US because the US economy recover very quickly, but Europe is just now. It's just 1.5 years ago.
What about default rates? Because that is clearly the big risk of that asset class.
Default rate still extremely low in Europe, in US, and it's still, and the forecast of Moody's, of the rating agency, are expecting very low default rate. Why? First of all, because in Europe we have still the ECB injecting liquidity and preventing for any default rates rising. But in US it is not exactly the same. Why? First of all, we have the energy sector, which is in distress because of shale gas, and we know that with the drop of oil price, make the environment for them very difficult. But in Europe, this energy sector is not significant. So it's not a problem for Europe.
Well, the energy sector is about 15% of the high yield index in the US.
Exactly. But in Europe, it's less than 5%.
So one of the advantages of the class is that the US spreads are spreading to Europe. So it makes the class even more attractive because you have the return without the risk.
Exactly. We have always a very big, good correlation between the high-yield US market and the European high-yield market. Always a good correlation. And the levels of spread are, I would say, similar. But the risk, like you say, are not the same.
Yes, because of this, this energy problem. Now, Oddo builds dated funds. What is the advantage of a dated fund, or target date fund, rather, as it's called?
Well, the idea was coming up to provide a very simple strategy to the investor. And the simple strategy is to constitute a high-yield basket of bonds, of high-yield bonds rated single B, in order to be immunized from future rate rises, and also to be only incentive on credit risk. And this is the goal of this dated fund. The second advantage is that because it is dated, with time, the credit risk will diminish.
You've explained to me that the returns will be much higher in the first 2 years, and then because of the curve, of the interest rate curve, the long rates being higher than the short rates, and then it will slowly decrease.
Exactly, because on this type of fund, dated funds, we have a very good visibility on return. We know if we have no default in our portfolio, what will be the return at the end of the maturity of the fund. But the return, when we said, okay, today it's 6.5% growth of fees each year during 7 years, the return will not be 6.5% each year. Because, like you said, because of the shape of the curve, we will have much higher return the first 3 years and lower return at the end. So it's very good to be invested now, and why not to take profit in 3 years.
Okay, thank you very much for joining us today.